Hey, hello everybody. Let's talk about my favorite subject, saving money. And when it comes to saving money, one of the best places you can put your money is an IRA. The IRS lets you put up to $5,500 per year tax-free away into an IRA. So when you're looking at your IRA company providers, the very most important thing I think you need to look at are fees. The best way to think about fees are they erode your investment over time. One major fee that you're going to look at is an expense ratio. If you're going to invest in a mutual fund, there's something called an expense ratio. And for easy math, an expense ratio of 1.00 means they're going to take 1% of your money per year. So that might not sound like a lot. Say you have $100,000 saved up, they're going to take $1,000 of that per year. If you have $1 million account, that's going to be $10,000 per year. That is a lot of money. And the best way to think about this is over a period of time. I like to use a 10-year timeline. So 1.0 expense ratio is going to be $10,000 if you have a $100,000 investment. Let's say you had $1 million investment. This is assuming no growth. They are going to take $100,000 over a 10-year period, which is a tremendous amount of money. So you do really need to pay attention to fees and expense ratios because these are going to occur over the life of your investment. And the lower your fees and the lower your expense ratios, the better. So some people like to own individual stocks. That is one way to go, especially if you have a tremendous amount of money to put away. You can afford to put them into individual stocks maybe, and you don't really care because you'll have enough put away anyway. But mutual funds are definitely a good way to diversify if you don't have a lot of money. So expense ratios. The best way to avoid high expense ratios are to go with index funds. The reason they're so cheap is because basically they look at indexes, which are established lists of companies, and they just buy the index. A lot of them will do this in a kind of balanced way based on their capitalization. So a very large company they will buy a lot of, and a smaller company they will not buy as much of on the index. So another great one is, let's say, the Vanguard Total Stock Market Index. That basically buys the entire stock market weighted by capitalization. So if you're going to look on there, you're going to see a top 10 of the very best and biggest companies. You're going to see like Apple, Facebook, and companies like that in that index. And the expense ratio on, let's say, a Vanguard Total Stock Market Index is 0.04, not 1.00, 0.04. So that's a very small expense ratio because there's no big fee basically to manage the fund. I will say sometimes an expense ratio is okay. There's funds that do very well. T. Rowe Price has some very well-performing funds. They'll have an expense ratio in, let's say, the 0.8 area. And I'll say that an expense ratio of 0.8 is okay if they're outperforming their next best competitors by 10% per year, let's say. So basically, the best way I like to think about it is, in real estate, they say location, location, location. Well, in investments, it's fees, fees, fees. Watch out for the fees and stay away from the fees and think about your fees. Think about what kind of investor you're going to be and look at each IRA and how much fees based on your investment style. All right, let's go into it, and we'll start right here with Ally. Ally has very low commissions, reasonable trades right there, $4.95, and if you have over $100,000, $3.95. That's a very good deal for your trades. No minimums or maintenance or hidden fees, free real-time quotes, supposedly top-rated customer service, and fee-free IRAs. They also offer something called a free DRIP. That's a dividend reinvestment plan. So what does that mean? Let's say you own some stocks and they pay you some dividends. That's going to be some cash sitting in your account. So if you did not have a dividend reinvestment plan, you would have to pay another $4.95 and go buy some more stock with those dividends. But if you have a dividend reinvestment plan, it automatically buys more of the stock. Some disadvantages, potentially, if you like to buy dollar stocks, it's an additional penny per share for stocks priced less than $2. And there are no transaction fee funds. Some of the other larger companies might offer fee-free to buy and sell their own managed funds, like Vanguard and Charles Schwab will have that kind of a feature. So definitely look at what kind of investment style you're going to have and look at the fees and estimate based on your investment style what kind of fees you're going to pay from each of the different providers. Our next provider is Charles Schwab, and they're a big one. They are very large with over 300 plus offices. They're likely to have an office near you where you can physically go and talk to people. Some of the other pros for them are personal guidance available at no additional cost, no account maintenance or inactivity fees. They also offer free dividend reinvestment plans. They're supposed to have excellent customer service, and they offer, most importantly, over 200 ETFs with no commissions. That means you can buy and sell them without a fee. However, you do need to pay attention because some of the hidden fees could be, a lot of them will say if you sell within 30 days, 60 days, a different number of days, there will be an early redemption fee. So keep that in mind if you're a kind of trader that buys something and sells it in less than a month, 2 months, 3 months. You need to look very carefully for those kind of fees. Some of the downsides are potentially high commissions on mutual fund purchases. $76 to buy is incredibly expensive, and high margin rates. So try to figure out what kind of investor you're going to be. Charles Schwab might be good if you're just going to buy and hold stocks. I have a friend of mine who that's his game plan. He's a very wealthy person, though, so he can afford to have stocks go up and down, and he doesn't have to buy mutual funds. So the advantage of that is he doesn't have any fees from the expense ratios if you just own stock. So Charles Schwab is a real big one, definitely one worth looking at. And let's keep the ball rolling here. Next one on the list is Fidelity. Fidelity has a good selection of commission-free mutual funds. They have no account and maintenance or inactivity fees. They are supposed to have good customer service. They have other good things like banking services such as checking, savings accounts, and credit cards. And they also have 91 commission-free ETFs. That's pretty good. Some of the cons are very high commissions, $49.95, some as much as $75 for some mutual funds to purchase non-Fidelity mutual funds. They have a $12 annual low balance fee for each non-core Fidelity mutual fund if your balance is under $2,000. So this is one to think of if you are not a large investor. They also have a relatively high $2,500 minimum to open an account. That's definitely a good thing to start talking about is you might need to pick one of these starting out as a small investor and then transition into a different one as you become a larger investor. So definitely constantly look at the different IRA providers and what they offer and where you are in your retirement plan, because some of the larger ones, once you get a substantial balance, will give you substantially better rates. Because you're a large customer. So they're pretty good at $4.95 per stock trade. So one to look at. Let's keep it rolling. And last one today we're going to talk about is Vanguard. Vanguard is a very large provider. Vanguard is also I believe it was the one to champion and come up with the index fund. They are very big into low-cost mutual funds. Their low cost and good performance of their funds is what sets them apart. They have commission-free Vanguard ETFs. They also have free dividend reinvestment plans. And if you are a very large investor, over $500,000, they have very low commissions. You'll see from this that it drops down to $2 per trade. That is incredibly cheap. Pardon me. Some of the cons of Vanguard are their high commissions for most active investors. They are said to have a poorly designed and difficult to navigate website. There is a $20 annual account fee unless you have electronic statement delivery. They do not have an advanced trading platform, and they have very basic trading tools. So they are said to be the low-cost provider is how they kind of build themselves. So something to think about. So another thing I'd like to say about Vanguard is their phone support might not be the best in the world. I had a friend who had a problem with them, and basically he opened up an IRA, made a mistake on a bank account number, I think it was, because their picture was kind of vague, I guess, as to where the account number ended and the routing number began, and he basically added some extra numbers that shouldn't have been in his bank account number when he was setting up his bank. And that little small error triggered a chain reaction of problems. So basically, long story short, he ended up doing 2 buys, did not have sufficient funds to buy because the bank fell off, then was told to add the new bank, made a second purchase, which was purchased incorrectly because of poor phone support as to what and how that should have been done. So basically, it was like 4 phone calls, and the person ended up with their account having a, if you do this 2 more times, we're going to freeze your funds. So they called into the tech support, and 3 times did exactly what tech support told them to do, and for all they know, they now have been had something filed with the SEC for buying without having sufficient funds to cover. So anyway, sometimes a low-cost provider is not the best thing in the world, and there was a good website that kind of put together a summary of hidden fees. So something could look very good up front, but you need to very much understand the fees of how your account is going to operate over time. So it's always very important to go to each provider's website, and they'll usually have a little thing that says fees. It'll be a link somewhere. You can click fees, and there will be a whole page, maybe scrolling pages of different fees for different ways you do things. So you need to figure out what kind of a trader you expect to be and look at their fees and how that's going to affect you over time. And we'll wrap it up with saying you should go out and do your research. 2 great sources for putting this presentation together were brokeragereview.com and NerdWallet. I started out at NerdWallet and ended up at brokeragereview.com. So one thing I'll say about NerdWallet is they have a very good summary page. I didn't want to pirate it, but they have a summary page that lists a whole bunch of the top providers, different fee structures. They lay it out in a very, it's very complicated, but a fairly easy to read way for how complicated the different fee structures are for all the different companies. So, and they also kind of give their personal opinion as to good or bad. So definitely I would go out there and do your own research. There are a ton of IRA providers, and they all have different fees. Most importantly, look at the expense ratios. Make sure what kind of expense ratios are going to be available to you on the funds provided. I had to ditch out of my company 401k provider had an IRA, and my poor understanding of what was happening, I was laid off and I felt I had to move my money out of the company's 401k, and I thought I would just move it into the same provider's IRA. And when I got there, I was shocked at the cost of the expense ratios of the funds, the limited amount of funds. It was like a $25 fee to buy and sell every fund. So you can imagine, and then I ended up having to switch out of that. So do your homework ahead of time and know which IRA providers you like.